When investors ask me what stocks should I buy, my answer is always simple. Don't buy stocks, buy businesses. Because in the short term, market fluctuates, but in the long term, earnings, execution, and discipline decides who actually builds wealth. In today's video, I am sharing 7 stock picks for 2026 across large cap, mid cap, and small cap. These are businesses showing real traction with clear growth runways and, most importantly, the ability to compound through market cycles. These are not momentum stocks. I am not looking for a double in 6 months or 1 year. These are businesses I am buying or holding with long term mindset. Let's get started. Hey there, I'm Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and in Indian markets. A quick disclaimer before we proceed. I am not a financial advisor. This is not a buy or sell recommendation. Please do your own research before investing. Okay. I generally look for businesses that can grow earnings faster than economy over multiple years. These are not short-term bets, and I plan to hold them for 1 to 2 years unless there is some significant directional change in the business. These are companies I believe could compound in the year 2026 and beyond. By the way, don't skip the next segment where I share my market insights and how I build positions. Thanks again for excellent feedback and comments for the last video on Nifty up, portfolio down, and how to fix it. In 2025, we saw something interesting. While select large caps performed very well, mid and small caps largely struggled. Looking ahead to 2026, earnings are improving, the economy resilient. So, unless we face major shocks like geopolitical conflicts, trade wars, new pandemic, or a financial crisis driven by excessive debts, I expect broader markets to perform better in 2026. That said, caution is always healthy. I prefer to keep 10 to 15% of my portfolio in cash so I can take advantage of market pullbacks when they come. Another important rule I follow in my investing journey: I never buy a stock all at once. If my target is say 100 shares, I start with the 10 or 25 shares and add more only after the stock moved up by say 5 to 10%. This way, I am watering healthy plant, not throwing good money after bad. Alright, now let's get into the stocks. So coming to bucket 1, large caps. So first in our list is Ambuja Cements. Ambuja Cements is part of Adani Group with pan-India footprint. The group now owns Ambuja Cement, ACC, Orient Cement, and is in the process of acquiring Sangi Cement. So, why Ambuja? 1. India's cement demand is expected to grow at 7 to 8% CAGR. 2. Strong cost efficiencies from scale and logistic integration. 3. A long-term beneficiary of housing and infrastructure capex. Coming to recent financial highlights, Q2 volumes grew 20% year over year to 16.6 million metric tons. EBITDA improved to 32% year over year due to cost optimization. And third, almost zero debt balance sheet. In terms of key risks, I see 2 risks. 1, cement pricing remains cyclical. 2, energy costs can pressure margins. Now, next in our list is Tata Capital. Tata Capital is quite a financialization story, and it came to market recently via IPO. Why do I like Tata Capital? Tata Capital has deep synergy with the 70 plus Tata Group companies. 2, it has partnerships with 1000 plus Tata dealers, vendors, That's a huge advantage. 3. India's credit to GDP ratio is still far below global averages, so huge runway ahead. Looking into some of the highlights. 1. Well diversified portfolio across retail, SME, and corporate lending. 2. Healthy AUM growth with a stable asset quality. 3. Improved profitability trajectory. So, what are key risks? Regulatory tightening of NBFCs and then credit cycle downturns. So, third in our list is ICICI Bank. ICICI Bank is a textbook turnaround to compounder story. So, what is investment thesis for ICICI? 1. Private banks continue gaining market share from PSU banks. 2. Strong digital ecosystem improving efficiency. 3. High quality balance sheet enables faster growth. Looking into recent financials, there is healthy loan growth across retail, business, corporate segments. Second, asset quality is great with the gross NPA at just 1.58%, net NPA at 0.39%, multi-year lows. And return on equity consistently around 18% also great. What are key risks? Global slowdown impacting credit growth is one of the key risks. Then margin pressure due to interest rate coming down. So first stock in our mid-cap bucket is Pine Labs. Pine Labs is a technology-first digital commerce platform operating across India and global markets like Singapore, Malaysia, UAE, Australia, US and Africa. The market cap of around 27,000 crores by Jan 2nd puts Pine Lab almost in large cap category. So what is the rationale for investing in Pine Labs? Pine Labs mission critical payment infrastructure is used by top banks and retailers in India and in other countries. Strong opportunity in BNPL, which is buy now, pay later monetization. Platform of choice across sectors, top banks, top 3 oil companies, top 3 retailers in India. Let us now look into financial highlights. Transaction volume is up 92% year over year. Positive PAT in the last 2 consecutive quarters. Merchant base has crossed massive 1 million. On the risk side, most important thing is highly competitive fintech landscape in India. That's the only key risk. Moving on to second stock in Midcap, TD Power Systems. TD Power manufactures custom AC generators, electric motors, serving industrial and power and export markets. So, why TD Power? 1. Strong tailwinds from power and industrial capex revival. Order inflow is up by 45% year over year with a diversified order book of about 1,587 crores. And then strong operating leverage in an upcycle. Okay, let's look into recent financials. Strong revenue growth driven by exports, PAT up by 49% year over year, improving balance sheet. Coming to key risks, one major risk I see is the order lumpiness affecting execution timelines. Coming to small caps, high alpha, high risk. First stock in our small cap is V2 Retail. V2 Retail is a grassroots consumption story focused on tier 2 and tier 3 cities in India. With a market cap of rupees 8,900 crores on Jan 2nd, it has already moved to mid-cap category. Investment thesis, affordable fashion with resilient demand. 259 stores and expanding rapidly. Long runway for store expansion. How about recent financials? Revenue up by 86% year over year in Q2. EBITDA up by 151% year over year. Strong same store sales growth and gradual margin expansion. Key risks. 1. inventory management is quite challenging in retail business. 2. Fashion demand volatility. Second, stock in small cap is under the radar public sector stock, MIDHANI. MIDHANI is a strategic PSU and the only manufacturer of titanium alloys in India, serving defense, space, energy and aerospace sectors. Why I am excited about MIDHANI? Strong defense indigenization push, long-term space and aerospace demand. Third, very high entry barriers. Now let's look at recent highlights. Order book supported by long-term defense programs, stable margins, strong government visibility. Coming to key risks, there is heavy dependence on government orders. In nutshell, 2026 will not reward speculation. It will most likely reward ownership of quality businesses in the long term. Large caps provide stability, mid caps deliver scalable growth, small caps create alpha when sized correctly. You don't need perfect timing, you need patience, discipline, and conviction. If you found value in this video, hit like, subscribe to Compound and Grow. Invest smart, grow steadily, compound patiently.